Maximize Business Value podcast. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition their business on their terms. Our mission was born from the lessons we've learned from over 100 business transactions, which fuels our desire to share our experiences and wisdom so you can succeed. Now here's your host, CEO of Mastery Partners, Tom Bronson.
Hi, this is Tom Bronson, and welcome to Maximize Business Value, a podcast for business owners who are passionate about building long-term, sustainable value in their businesses. In this episode, I'd like to welcome our guest, Joel Crouch, who is a tax attorney and partner at Meadows Collier, Reed, Cousins, Crouch, and Ungerman. I know they don't usually use that.
Thanks for getting the Crouch in there. I appreciate that. My mother appreciates that also.
I always have to throw that in there because you're a named partner. He provides tax and legal advice to businesses, wealthy individuals, and families about their most demanding tax planning, IRS controversies, and estate planning. Now, I met Joel through Provisors, the professional networking group that you've heard me talk about many times on this podcast. Let me tell you a little bit more about Joel. He's been recognized as one of the best in his field by Texas Monthly and Law and Politics magazines, and by being named a Texas super lawyer from 2003 through 2021. He's also been named one of the best lawyers in Dallas by D Magazine every year since 2012. He's been recognized by Best Lawyers in America in tax law every year since 2015. And he was recognized by them as Lawyer of the Year in tax law for the Dallas-Fort Worth area for 2022. Joel has been recognized as a top-rated lawyer in white-collar defense by ALM, as published in the American Lawyer, Corporate Counsel, and the National Law Review. And he's also published various articles regarding IRS and tax procedures in those and many other publications. I got to tell you, I'm a little bit intimidated to have Joel on the podcast, but welcome to Maximize Business Value, Joel. How are you?
I'm glad to be here. Glad to do it with you today.
So why don't we start by having you tell us just a little bit about Meadows Collier. So I won't, you're in there, you're named in there, but you guys go by Meadows Collier, right?
We do go by Meadows Collier, and I generally introduce myself as part of Meadows Collier. So we're I think people would describe us as a tax boutique law firm. We have about 30 attorneys and we deal with all sorts of tax issues. I do a lot in the tax controversy area, dealing with the IRS. I also have clients who we do tax planning for. We do pretty sophisticated estate planning. Our clients are generally entrepreneurs, small business owners, small, closely held business owners, family businesses, those kinds of things. I've been here, I would tell people this. I've been here 34 years, almost 34 years, my entire career, which means I either like what I do or I don't interview well, one or the other. I have no idea which one it is, but I like what I do. I like the people I work with. It is interesting work. It is challenging work, which is what you always want, something to challenge you. But it's fun work. And when I came out of law school, it was kind of what I decided I wanted to do.
It's funny. I mean, did you clearly, 12, take yourself back to your 12, 15-year-old self. Oh, someday I want to be a tax lawyer, Dad.
No. Does anybody dream of that?
So, why did you decide to become, look, thank God for people like you, right? Who really enjoy this, but why did you decide to become a tax attorney? And you've been doing that your whole career.
It's a long and terrible story, Tom. I have to tell you that, but I'll shorten a little bit. So when I was in college, I decided I was going to be a math major and I was going to go teach math in school until I student taught 7th grade math. And that convinced me right there I needed something else to do. And so I ended up going to law school because my then girlfriend, who turned into my wife, was going to law school. I said, I'll do that too. So I ended up going to law school. And when I was in law school, first tax class I took, I went, okay, I kind of like this. But I didn't want to do straight just planning tax work. I wanted to do something different. And so I found this firm, which at the time was the only one in town here in Dallas that really did civil and criminal tax work. And is kind of the area I wanted to get into. Obviously, it's expanded beyond that, and I do some planning, also estate planning for clients, but primarily I'm still doing controversy work. And this was the place to land at that time. And so that's why I ended up where I am. I liked tax when I was in law school. I know that's terrible. It makes me out as the biggest nerd in the world at this point, but so be it.
Yeah, you're one of those guys that curls up on a cool winter night, next to a fireplace reading tax code, don't you?
Oh, nothing better than that.
Nice glass of wine and nothing like reading the tax code. Now I imagine that your relationship with many of your clients starts like right after they receive a letter from the Internal Revenue Service, right? So let's say that my company's been notified that its income tax returns have been selected by the IRS for examination. Is that how many of your relationships start? And
yeah, and usually what happens is the client doesn't contact me. Usually their CPA calls me at that point and says, "Hey, we got an issue here potentially." It is, and it depends. I get called in at certain times. I may be called in during the exam phase. I may be called in, and the other things. There's levels above that you can go to. But they'll get that letter from the IRS, and a lot of times the question is, why me? Why in the world did I get picked? That's not an uncommon question. And the way the IRS decides who they're going to examine is based on a number of different things. There's something that's called the DIF score. I believe it's I'm trying to remember. It's called the discrete fund. Anyway, it scores a tax return. Basically, they take a look at the return. It's scored when it comes into the IRS based on how similar returns, and it says, okay, this one looks off a little bit. For years, we've all been trying to figure out get the code for the diff scoring so that we could do our tax returns in such a way that it would be as low score, but nobody's ever been able to track that down at this point. The IRS won't give it to us. The other thing that can happen is let's say there's a matching problem. There's some information the IRS has that doesn't match up. It doesn't appear it's on the return. Picked up that way. The third thing that can happen is your client may have participated in what we're seeing a lot more now is what the IRS calls a reportable transaction. It's a transaction in which the IRS is kind of keeping their eye on. Some examples of that are right now there's a couple of big ones that are out there that are called micro-captive insurance. The other one is conservation easements, syndicated conservation easements, both of which are legitimate planning tools, both of which are good planning tools, but have been subject to maybe some abuse. And so the IRS knows this. And so they are kind of tuning on those kinds of things. And so that's generally I see it's one or two things on the return that have jumped up. Oh, let's take a business. If a business is reporting losses every single year, that's going to cause the IRS to take a look at it. So that's something it can jump up also. So business is already looking. I have clients who ask me all the time, is this a red flag on the return? All depends. IRS these days, their examinations are low, not as doing as many, but if you think it's aggressive, it may be a red flag to the IRS.
Interesting. Now, and a lot of people, especially small business owners, manage their finances to minimize tax consequences, right?
Yeah, and I would tell you the one thing that I would add to this is the one thing I see with most of my clients are small businesses or closely held businesses, family businesses. There's always that blurring of the line between what is business and what is personal, because probably like your clients, my clients, a lot of times what they do and everything they do, including almost everything in their personal life, is got a business taint to it somehow. In other words, they're doing it for business purposes. And so a lot of times you get this kind of mixing of business and personal, and you can sometimes get into the problem there on the expense side.
Yeah, no doubt. I do tell our clients that you want growth, and just especially as you're getting close to a transaction, just pay your damn taxes now. Yes. Right.
Don't tell them that, Tom. That would put me out of business.
I know. You're right. No, I want you. Look, they need your help for more reasons than that. So now, are there any? Can the IRS just go back as far as they want to, or are there any statute of limitations on how far they can go back on
like everything else? Yeah, well, like everything else, there is a statute of limitations. It's generally 3 years, but like anything else, there's also exceptions to that. So 3 years from the date the return is filed, generally is your statute of limitations. If it gets beyond 3 years, you're pretty much home free at that point. There are exceptions to that. There's a what's called a substantial understatement, which means there's a 25% omission of income. That's a 6-year statute of limitations. There is a statute of limitations, no statute of limitations if you file a false return. If there's something fraudulent on the return, and the IRS has the burden to show there's something fraudulent on it, there's no statute of limitations on that. It's open-ended at that point. And then also, with any situation, the IRS can ask the taxpayer to file or to assign a statute extension. In fact, what we're seeing these days is almost out of the box on every examination, we are being asked now to extend the statute of limitations.
Now, so why would you agree to that?
Well, you're talking to one person who does not believe in extending the statute of limitations.
Yeah.
The reason you might do it is if you think you're close to getting it resolved. I mean, in other words, a little more time may get it resolved. There are ways to extend it that you can extend it for just a specific issue. There are some options there that you have. I'm not, if it's just a general extension of the statute of limitations, I'm just not a big believer in that. I don't think it's a great idea, but the IRS will not, the way they approach people, it's almost you have to do it. And we always tell clients, you don't have to do it. And let me tell you why you shouldn't do it. And the reasons not to do it are, why do I want somebody from the IRS having more time to look at your tax return and try to find justification for the time that they put into it? There's just no reason to do it. The answer for a lot of times from the IRS is, well, but if you don't do that, we'll have to send this, this, and this. And we can talk about this in a second if you want to, but frankly, there are options for now dealing with. The exam is not your final place. There are options above exam. There are options for doing it and dealing with it. So, it's not the end of the world if you don't agree with the exam. I've had one case in my career, Tom, where I had somebody, this is a long time ago, where there used to be a way you extend it. They used to have what was called an open-ended extension. Now they just have you extend it for a year or something. And I got approached by a company that said, we have an open-ended extension. It's been going on for years. It's been going on for 10 years. And the IRS had not been even shown up. And it's just continuing. So we filed and stopped the extension. But we told them before we did that, said, what's likely going to happen is the IRS is going to disallow all the expenses. So you're going to have a big number that shows up. We'll deal with it on the IRS end, but it's not a problem at the end of the day. It shouldn't hurt you at all. We stopped the extension, and basically the IRS has walked away at that point. I mean, those are few and far between, but they do happen.
That's one of those deals where, the guy that actually started it, he's been dead for 5 years, and nobody at the IRS can understand why we even opened this in the first place, right?
Yeah, exactly. I mean,
well, it's a bluff, right? It's a bit of a bluffing game.
It is. There's no
all
doubt.
The way around. So what happens if you just don't respond to the IRS if they send you a letter saying that they're going to do an exam? And what happens if you just choose to not respond to them?
They're going to look for ways to get you to respond. I mean, they're going to do a couple of things. One is they can contact third parties to try to get information. What they're trying to do is, trying to find information. If you don't respond, they're going to keep pushing to try to get there. Ultimately, if they cannot get you to respond and it's close enough to the statute of limitations, they will issue what's called a notice of deficiency. Essentially says, look, based on the information we have, here's what we think it should be. You haven't provided any substantiation for your expenses, for example. So because you haven't provided those, we're disallowing all those. You get the notice of deficiency. The option then is to go to a different level at the IRS at that point. That's not the end of the day. But my point to clients is when this kind of question comes up is, look, let's try to get this resolved at the IRS as quickly as possible. Digging in your heels and not responding is not going to be the best answer, but they can go because they can make your life difficult. So it's best to respond and try to get it resolved.
Yeah, I for sure. I can't imagine just not responding, but I'm sure that there are different things that go through different people's heads, or that worse, they don't reach out to someone like you. They get a notice and then they ask for that extension, and they go ahead and grant the extension before they talk to an attorney about it. There's too many times business owners think, well, I have to respond because it was a government thing. No.
Well, that's the other thing. Well, I thought you were going to say the one thing I have seen in the past is people see a letter from the IRS. It comes by certified mail, and they just don't open it. And what happens is ultimately they start getting more letters and letters, and they finally come see me, and they've got a stack of letters on which nobody's ever opened. There could be a check in there for all we know, but they just don't like seeing a letter from the IRS. It's got to be bad news. Must be bad news coming from the IRS.
Oh my God. Well, it makes my heart skip a beat every time I get one of those. And it's funny. I've gotten one every year, not an examination letter, but I've gotten a letter from the IRS, and it stops my heart every time, because I've had somebody in college for the last 12 years. And every time I have to do the FAFSA, right?
Yes.
Fill that thing out. Then I get a letter from the IRS saying that someone filled that out. Well, okay. It makes my heart skip a beat though every time I go, oh, I got a letter from the IRS. Why? Now, let's say you get into the examination, you get into it with the IRS. Does the company have any rights during that examination?
Yeah. Look, first of all, there's a couple of rights. One is actually in 1998, the IRS came out with what they call the Taxpayer Bill of Rights, and they came out with various rights the taxpayer had because of abuses that had gone on in the examination process. In other words, in other places in the IRS, there's the right to understand what the examination is about. There's a right to have a representative represent you in it. There's a right not to be interviewed by the IRS. One of the questions I always get from clients is, do I have to talk to the IRS? They really do not want to talk. And the answer is, no, you don't have to. Generally, I stand between you, or your CPA stands between you and the IRS, and they're the person there on your behalf. They're there to represent you. They're there to be the person who communicates with the IRS. There are some exceptions to that. One of which is if the representative can't answer the questions like what's the client's business about, they'll try to get around your power of attorney at that point. But that's probably the most important one is that there's the right to have a representative there on your behalf, so you don't have to communicate with the IRS. What I always tell my clients is, look, you're good at what you do. You have a great business. You know what you're doing in your business. I couldn't tell you how in the world to run your business. You go run your business. Leave this to me, and I'll come tell you when we need to deal with issues. But let me do it, or let your CPA do it, whoever. But make sure they're doing it properly, and let them go. So the rights are there. The right to have it examined at a convenient time. There's a right to present information and to tell your side, those kinds of things. So, but the examiner will come in, and their way of getting people to do things is try to intimidate them. And most people are very intimidated by the IRS. And so you understand why they do it. It's just having somebody there on your behalf, whether it's your CPA or other tax professional, is very, very important, I think.
Yeah. You don't want them to make a decision in a vacuum, for sure.
No.
One last question before we take a quick break, and that is, so you'd already sort of touched on this before, but what happens if you go through the examination and they come out and they tell you, here are your charges, here are your penalties, blah, 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 and you don't agree with what the examiner is proposing? What happens then?
Well, there's a couple of options. One is, and the traditional way of doing it is there's a division of the IRS called the IRS Appeals Division. They are the next level up. That gives you an opportunity to go deal with somebody who's going to take a fresh look at it. And I always tell clients, the higher you go in the IRS, the more discretion. People exam, it's a black and white world. As you move up, the gray moves into it. They're also looking at what the risks are. They're going to lose this issue if they were to go try it. They're going to look at all those kinds of things. So if the IRS issues what's called a 30-day letter, which says this is what we believe, the examiner does, you then have a right to file a protest that goes to the appeals officer. You have 30 days to file that. That can be extended for another 30 days, generally extended for another 30 days if you need it. There's an exception to that is right now the IRS Appeals Division requires, getting back to our discussion before, requires it to be at least a year on the statute of limitations before they will accept a case in appeals. And so one of the questions you may get, and this is where somebody may want to extend, and I've extended under these circumstances, I have extended the statute of limitations so that appeals could take a look at my case. Now, there are some other options. If you don't want to extend the statute of limitations, the IRS will then issue what's called a 90-day letter or notice of deficiency. That means you have 90 days to file a petition in U.S. tax court. Tax court sits in Washington. That's where all the judges are. And you petition the tax court, and your case is then assigned to a tax court judge. The judges travel the country. Well, they're here in Dallas 3 or 4 times a year. One judge will be here 3 or 4 times a year, and they'll be here for a 2-week time period in which they try cases at that point. It's tried. It is a prepayment forum, which means you don't have to pay. You can pay the $60 filing fee, but you don't have to pay the tax or anything associated with it until that case is resolved. Now, the good thing about that is one kind of side note, and this is what the examiners don't ever understand is, you file a tax court petition. Once the government files their answer, the case is then actually sent back to that IRS appeals office I was talking about. So that's another way to get to appeals. And that may be a reason you don't want to file extend it, because it kind of pushes the case and gets it where you want it to go quicker that way. The other option is a payment form. You pay the tax, you pay the liability, you file a claim for a refund. When the IRS denies it, you file an action in federal district court or a court of federal claims. Most of it, the vast majority of my cases are going to end up in tax court because nobody wants to pay before they have to get it decided. So that's where you're going to end up being, most of your cases are going to end up.
That's where, as we're sitting here and I'm listening to your response to this, my brain is just coursing through all of the different tax issues that I've had as a business owner. But we'll get into some of that stuff in just a second. We are talking with Joel Crouch. Let's take a quick break. We'll be back in 30 seconds.
Every business will eventually transition, some internally to employees and managers, and some externally to third-party buyers. Mastery Partners equips business owners to maximize business value so they can transition their businesses on their terms using our 4-step process. We start with a snapshot of where your business is today. Then we help you understand where you want to be and design a custom strategy to get you there. Next, we help you execute that strategy with the assistance of our amazing resource network. And ultimately, you'll be able to transition your business on your terms. What are you waiting for? More time? More revenue? If you want to maximize your business value, it takes time. Now is that time. Get started today by checking us out at www.masterypartners.com or email us at info@masterypartners.com to learn more.
We're back with Joel Crouch, tax partner at Meadows Collier, and we're talking about tax issues. And before the break, we were talking a lot about IRS types of things. But let's talk about some other tax issues that are fairly common, I think, in businesses as well. So I hear this all the time. I've got employees. Some of them are independent contractors. Should I be worried about an IRS employment tax examination? We all know about income tax examinations. What about employment tax examinations?
The answer is that, I mean, we see it come up. Now, generally it comes up in a not independently. It comes up as part of the examination of the business. They'll look into the employment taxes also. It can come up independently if you've got somebody who you've been treating as an independent contractor, and they file what's called a Form SS8 with the IRS. That essentially says, no, they should have been classifying me as an employee, and they should have been paying their portion instead of me of payroll taxes instead of me paying both sides of it. You can see it come up in those circumstances. The other place, and what I've always told, this is when you get to independent contractors, it's a tough issue sometimes. You got to be business owners, when they have people who are employees and independent contractors, you got to be very careful, because if you have the same people, if you have people doing the same work, some people as employees and some people as independent contractors, you're going to lose that issue with the IRS if they're doing the exact same thing. Now, I've seen situations where people have had a person who they're treating partially as an employee and partially as an independent contractor. You're going to lose that also. They're W-2s for some reason, for some parts, and 1099s for others. The issue on independent contractors always is control. Are you, as the business owner, controlling how the work is done and when it's done? And that's a simplified version of it, but that's essentially what it is. It's the control factor. There are things that I've done for my clients through the years to try to help them put in a position, if they're going to have independent contractors, which many industries, that's what they have. And, that's just the way that they're treated, is to put them in a better position to be able to defend that. For example, if you have somebody who's an independent contractor, it's rampant within the construction industry. That's just the way it works. And I always say, look, if you're going to have somebody that's an independent contractor, have them set up their own business so that you're paying their business, those kinds of things. They're hiring other people to work for them. It doesn't work every time, but just be aware. But independent contractors it can be a very sticky situation. There are ways, if somebody really thinks they have a problem, to approach the IRS on it. There's a voluntary settlement program, some other things that can lessen the potential impact that you could see as a result of that.
So if you've got independent contractors, I think it's probably fairly safe to say, at least before a transaction, 3 to 5 years, even before a transaction. Because by the way, whether the IRS comes out or whether the buyer says, oh, we think this is a problem, right?
Yeah, let me tell you, the other place it comes up is there's sharing agreements between the states and the feds on this. And so if you get contacted by one, you're probably going to get contacted by the other too.
Right.
Exactly. Right. You're right. The buyer is probably going to take a look at that and go, I don't want to buy into that problem. And you got to go clean that up before we're going to do anything else.
Yeah. I always advise our clients that have that have contractors, at least have a conversation with someone like Joel to confirm or deny whether or not you're meeting all of the requirements for that person to be a contractor before you go on the market. Yeah.
And let me tell you the one key to this, because this is where it fails, where we have the biggest problem. You've got to issue forms 1099 to these people. You just have to. If you do not do that, most of the battle is lost at that point. Yeah. If the IRS looks at the examination, the first thing they're going to say is, are you issuing 1099s? If you issue 1099s, you're going to go in this category over here where we're going to have less problems. If you're not issuing 1099s, you got a bigger problem.
Oh, right. Yeah. I hadn't thought about that. Yeah.
If there's just one thing.
If you're issuing 1099s, then theoretically the IRS is getting their money. It might not be the appropriate way.
But you're doing what you're supposed to. You're reporting it, all those kinds of things. And as long as you're doing that, you're acting in good faith. I think you're going to be okay. You may get them reclassified, but the pain of getting it reclassified is not going to be as much as if no 1099s.
No doubt. So, another issue that comes up frequently is many business owners kind of routinely overstate their expenses. I know we touched on this in the first half. I know it's shocking, isn't it? So, and then suddenly when it's time to sell, they want to resolve this in any potential tax issues. Now, should they really go back and amend their returns, or are there other options?
Well, there's some other options, but let's talk about, let's say they were going to amend, and that may not be the wrong idea. You only want to amend those on what you think the statute of limitations is still open. So we talked about 3 years. Maybe you don't go beyond the 3 years, depending on your circumstances. If it's expenses, you're probably not going to go beyond 3 years, and so you can amend 3 years. The question comes down to this. The question is, because there's some other alternatives, and the other alternative is the IRS has a voluntary disclosure program. That voluntary disclosure program is really, if you look at it, is only for people who have criminal exposure. Let's assume our clients here don't have criminal exposure. But let me back up. Let's assume they do have criminal exposure. Then you're going to go back and you're probably going to amend 6 years worth of tax returns, because in criminal cases, it's a 6-year statute of limitations. Now, the difference is now you're going to be looking at a 75% civil fraud penalty on the highest year in which you owe additional tax. So that's going to impact. I've had more clients. I used to have lots of clients who did voluntary disclosures because it was just cleaner. You could get them in and out. You knew that this thing was done. You had an end to it. By filing amended returns, it's not as clean. You don't have this determination immediately. But there are good and bad to doing voluntary disclosure. One, 75% fraud penalty. Two, it takes a long time. It takes longer than you would think to get it resolved with the IRS. And if your client is looking at selling their business in the next year, I tell people these days, a voluntary disclosure program takes too long for that.
Okay.
So
And so, but it's a voluntary disclosure only when you've got criminal exposure.
That's exactly right.
Yeah. And so now, just for our layperson's ears, that means that there's potentially some fraud, right?
Yes, you intentionally did these things with the
Yeah.
intent of defrauding the IRS in some way. And so
I guess, technically, couldn't they make the argument that that's always the case, right? Right?
yeah, I mean, look, it's there. There's levels of fraud, though, Tom.
I know.
You know how it is. There's certain levels to these kinds of things. And really, is the IRS looking to make an example of somebody who is just paying a few expenses here and there that could be classified as personal versus business? Where you really see it's really not the expense side that you see the voluntary disclosures on. It's really on the income side. If you're underreporting your income, because that's really where the issue arises. And that's where you have to be very careful with those things.
People actually underreport their income?
I know you're shocked to hear that. I know you're very shocked to hear that.
Look, all right.
I've had people W-2s that have underreported their income. How they ever did that, it makes no sense at all, but it's happened.
Yeah. Crazy things, right? Okay, so another area which I know is not really your area of expertise, but we talked about it a little bit on the break, and I want to bring it up here, is sales tax, right? Because there's a lot of businesses that seem to always be under the assumption that they don't have to charge sales tax, right? Does it really pay? When should someone go back and look? Maybe when they set up their business, they say, "Oh yeah, no, you don't have to pay sales tax on this." So you never set up a sales tax collection device. When should you be thinking about, well, gee, I should ask the question, should I be charging sales tax?
Yeah, well, they should. I mean, to me, you should be asking it from the very beginning. The problem I have seen clients run into is circumstances where, let's say they are selling their business. Somebody starts looking at the books and records and realizes, yeah, you've been paying sales tax in Texas, but you've been conducting business in other jurisdictions. And frankly, you probably need to be paying sales tax in those jurisdictions too. And we need to clean that up. And then the question is, how do you do it? Like, once again, there's another voluntary disclosure initiatives out there. State of Texas has one. The other jurisdictions have them also. But it's one of those things that you see, you don't see it unless you're looking for it when you're doing your due diligence. And then it arises at that point. I've also seen circumstances, these are the extreme, where people have been collecting but not remitting it to the state. They've been collecting sales tax but not remitting it to the IRS or to the state of Texas. Or my most recent one was, we weren't collecting it, but we would give a discount of the sales of the amount of the sales tax if you would pay in cash, so that there was never any sales tax charged. And as a result, so that was the discount, and everybody knew it, including everybody that worked in the business. I can tell you all sorts of schemes out there that at the end of the day, you go, why in the world did I do this?
Wow. Especially if you want a business that is ultimately transferable.
Yes.
I had years ago, I owned a software company that did software for restaurants, retailers, and wineries. And I had a client who knew that I was in the M&A space, that I had bought and sold a lot of companies. And I was approached by this client of ours that said, hey, we want to sell our business in 2 or 3 years. And so would you do a little consulting with us? And what I came to find out was that they were paying a lot of people cash. They were, of course, in their restaurant and in their bars, they had a lot of cash transactions. They were siphoning all of that cash out of it. They were, clearly it sounded like that this was a case that, oh, good Lord, by the way, I told them, your business is not sellable for the value that you should be able to get for it, because no one's going to believe all these cash transactions. No one is going to understand this. And so my advice to you is, if you want to sell in the next, say, 3 to 5 years, is that you make a concerted effort over the next 3 years to make your business significantly more profitable, pay the taxes on that, because an auditable dollar will give you 10 times or more what an unauditable dollar will give you. What would be your advice to somebody who clearly recognizes that they've been operating sort of outside the law on those things, but they do want to clean it up now. Should they just come clean for a couple of years, or should they slow bleed it on? My concern would be that if they came clean all at once, boy, that's going to trigger audits in the past.
Well, okay, so let's take your example. I've had example, but same thing, restaurant industry. I had the same exact story, which is they had been skimming the cash. You got two different cash registers. You got credit cards going here. You got cash that goes in here. Credit card shows up on the returns. A little bit of the cash does, but most of the cash is all skimmed. Problem in my case was the IRS. I always tell people, if you're going to do a cash skim, don't tell your employees about you doing your cash skim, because you've now created a lifetime employment for that person. And sure enough, in my case, they actually fired the manager who knew all about it, who then turned around and went to the IRS. And the next thing that happened was the IRS showed up and did a search on the house at that point. So that turned into a nasty little criminal case at that point. So what do you tell? If somebody came to me, if that client had come to me before all this happened, I would have said to them, okay, you are a classic voluntary disclosure. You have criminal problems. You clearly have criminal conduct here. You are skimming the cash, which is not unusual in cash heavy businesses. It happens. And I would say you're going to have to do a voluntary disclosure and clean it all up going back. Because if you want to make it work, because you want to sell your business in the future, you need to show that you've cleaned up all problems. Just filing an amended return doesn't give anybody the assurance this is going away. The voluntary disclosure program actually brings an end to it. Says, okay, we agree with the IRS. IRS agrees with us. We owe this, we pay it. That closes out all years, even beyond the 6 years. I had a client one time who had been running a scam for 15 years. He was thrilled when we limited it to 6 years because he figured out he'd made more money than he was having to pay the IRS by the scam. One of my favorite clients. He was very happy with the fact that we were able to solve that problem because he ran numbers and knew he'd come out ahead somehow. But I would clean up. I mean, I think you've got to clean it up. Especially if you're going to try to sell your business, you got to clean those things up. Otherwise, somebody's hanging out there on that, and it's not a great position to be in.
No doubt. So we here at Mastery, we typically start working with our clients 3 to 5 years in advance of exiting the business. Are there things that business owners should be thinking about to reduce tax liability long before they exit?
Yeah, and the number one thing in my list, there's two things. The first thing in the number one list is if the client is a C corporation, they really need to think about converting to an S corporation. My career, when I started 34 years ago, we didn't do C corporations for anybody. C corporations were out, the high rates, all those kinds of things. And the last, since 2017 Act, C corporations have come back around because of this 21% tax rate. But really, I'm not a big fan of the C corporation. And the thing you got to do, you got to put time. If you're a C corporation and convert to an S, you got to put some time on the books. You got to get 5 years. You got to get rid of that built-in gain that you're going to have if you don't. So you've got to. This is not a question when they come to you, Tom, and say, "Hey, I got a buyer on the hook. I'm going to sell in 6 months. I need to convert from a C corporation to an S corporation." It's too late at that point. You're just going to have to deal with the higher taxes you're going to have to pay as a result of that. And be careful of something that you and I talked about the break, which is the Midco transaction. Be careful. There's a bunch of people selling junk out there. So if you hear something about a Midco transaction, run as fast as you can away from it.
Yeah, Midco. Be on the lookout for
my
that.
DCO. It's bad. It's bad.
Yeah. So, which is by the way, a transaction that claims, right, that they can solve this tax issue.
Yeah, they claim they can solve this, and it doesn't solve the issue. I guess the other thing is the thing that we see a lot of. It's just what we talked about, sales tax. We see it that people start doing due diligence, and they realize, hey, you're conducting business in all these other states now, especially how everybody's conducting business over the internet and those kinds of things. And so cleaning that up is really important too. I think those are the two things. S corporations, I think is the conversion from a C to an S is always the number one issue. I can't tell you how many phone calls I've gotten from CPAs. My client is about to sell. They're a C corporation. How do we deal with the fact they got double tax, and how do we get out of this into an S corporation? And I say, you got 5 years? Nope. Well, not a whole lot we can do at that point then.
Yeah. Now, is that an actual a law in the books that there's a 5-year look back period that
Yeah,
they
this
can
it's called the built-in gains rule. It's a
Okay.
5 year. I mean, you just got to get out 5 years.
Okay.
And
So you basically hold the business for 5 years and then you're in the clear.
so doing it now, if you're talking to them now about their business, that'd be number one on my list. You guys a C corp, get out of being a C corp.
And I advise clients, the hardest thing in the world, though, Joel, is business owners will say that they want to sell their business in 3 to 5 years, but on the average, they'll say that for 17 years before they start taking action on it. But if they would take action on it the first time they think of it, oh, gee, I was established as a C corp back in 1979 by my dad. I should convert that now, and then I don't have to worry about it in the long term. But then they don't think about those things until it's too late.
Right.
And that is always a frustration for guys like you and for guys like me, that if we'd have had this conversation 5 years ago, you wouldn't be in this situation.
Yeah. Or the other side is you say to this client, you say, well, when are you thinking about selling? Oh, I'm not selling for another 10, 15 years. I'll deal with that later on. We got plenty of time. And then they get an offer that they go, God, I can't turn this thing down. This is way too much money. And it's too late. And so just being proactive on those kinds of things, I think, is really, really important.
Yep. So also now the taxation at sort of a transaction, there's something that has to happen that a lot of sellers don't realize until the moment is upon them, and that is the allocation of proceeds in an asset sale, right? And it could have a significant tax impact. So what does that mean when you allocate the proceeds?
Well, okay, so you're getting proceeds from the sale. Let's just use an easy example. We're getting $1 million, let's say. Depending on what you're selling, if it's an asset sale, I mean, if it's a stock sale, it's easy. I mean, that's you're not doing any kind of allocation there generally. But if you're selling assets, you're trying to allocate what the proceeds were to what assets you're selling. For example, many of your clients, like many of my clients, there's going to be a goodwill element to that. And how you value that goodwill element is going to be important, because depending on what kind of assets you're selling, they're going to be subject to different tax rates. Some of them be capital gains rates, some of them be ordinary income. So, you're deciding how you're going to allocate that $1 million amongst those so that your gain is taxed at a certain amount. Most of us want to put as much as possible, probably goodwill, frankly. And so there's always the question of how do you value things like that? Sometimes we bring in, depending on the size of the transaction, we bring in somebody who's a valuation expert to help us do that. The difficulty becomes trying to negotiate with the buyer on that, because they may want them allocated in a different way because the tax benefits to them are a different way. Because if you can come to an agreement, the IRS believes and will not challenge an allocation if there's really a third party, an arm's length negotiation of that. IRS is going to recognize that. And so that negotiation that goes on, I think, is very, very important.
I agree with you. I had a fortunate situation. I was selling a company that was supposed to sell in kind of middle to late 2017, but we pushed the transaction into it kept getting delayed. By the way, if you're a seller, this is what happens. The can keeps getting kicked further down the street. But we wound up not closing this transaction until toward the end of February 2018. And a wonderful thing happened in between there, right? Was the Tax Act of 2017 in December 2017. The company that was acquiring us, we were unfortunately a C Corp. We made a mistake that forced us into being a C Corp. We took a non-qualifying shareholder, and it was too late at that point. And so had we realized within a reasonable amount of time, we could have fixed it. Anyway, circumstances, in here. So somebody who knows what they're doing, screws it up like that. But so here we are on a asset sale.
Okay, go ahead. I'll let you finish that.
Here we are on an asset sale, and then the tax laws changed. The buyer for us was Canadian, and for the first time in history, I think, the corporate taxes became, after the 2017 Tax Act, the corporate taxes became less in the US than they were in Canada. And so the Canadian buyer flipped it into a stock purchase, which was wonderful for us.
Unusual.
Right? Very unusual for us, and so we had the advantage of doing that. But yeah, luck is not always going to be on the seller's side.
Yeah, you know what? And that reminds me of something. It's one of my partners does this all the time. He's getting a year end. He will look at the client every time and say, "Do you really want to close this before year end? If we push into next year, you don't owe the tax until end of next year." So there's always that element that goes into it also.
Yeah, I know. We had a saying in one of my companies. We bought 72 companies, and our favorite closing day of the year was December 32nd. So, yeah, I don't know if you'd ever heard that before. Look, before we go here, what sets Meadows Collier apart from other tax and litigation firms in DFW?
I think what sets us apart primarily is the fact that we're just tax oriented. It's what we do. I mean, this is really what we do. We look at any kind of transaction we look at. We're always looking at the tax implications associated with. You kind of get a 2-for-1 with us. You get people who are both like on the transactional side, who are both can do the transaction and can do the tax side of it also. And I think that's the biggest benefit that we bring to the table is we don't bring a lot of professionals. We're going to bring a small team. We're going to come in and get it done quickly.
And this is why so many business owners need to have somebody that they can rely on to have these conversations far, far, far in advance, right? Yeah. It is so much better to be ready if in case a transaction just shows up on your doorstep one day, or in case some disaster happens that's unexpected and it forces a sale. It's so much better to do all this planning in advance. And I think that the folks at Meadows Collier would be a great place to develop one of those relationships. One last business question before we go. This podcast is all about maximizing business value. Now, you've worked with a lot of clients over many, many years doing what you do. Joel, what is the one most important thing you recommend business owners do to build long-term sustainable value in their business?
And I tell every business owner is I'm going to say tax professional, but really the person they need a really, really good, sophisticated CPA. I mean, that person is worth their weight in gold. They need a good CPA that knows what they're doing. And they need to be able to recognize when they outgrow their CPA. That's the other thing. And that's a hard thing. And you have to have a discussion with them about that. But a good CPA will keep the client out of trouble and will set the client up, I think, on a really good path to being able to position that they can maximize the value, make them avoid the problems you and I talked about already, which is trying to clean up problems. A good CPA can help on those things. And then, when you're getting near the sale or you're thinking about it, get some good professional advice on the tax side from a good tax attorney on it also. But my number one is really the CPA. I think the CPA is the most important person.
I agree. And most people don't realize, and I've said this 1,000 times on my podcast, in my book, in fact, my new book, which is about to come out, I talk about selecting the right CPA, that those initials behind someone's name doesn't mean you have the right person, right? And so right. CPAs are cut from different cloth. And it is so important for business owners to have somebody who's got some transactional experience, yes, especially when it comes time to selling the business. Perhaps this guy's been this CPA has been great for your taxes and all that, but if they have no experience in transactions, you're going to probably want to get a different set of eyes on it.
Yeah, and the good thing, I think, along those same lines is some CPAs, all they do is take your information and put it on a tax return. They never go and look behind the numbers. They never sit down with you and say, okay, tell me what's going on in your business. Let's think about how we're doing this. Those are the kind of CPAs I'm talking about. And especially as, you and I have clients who have grown the business from the ground up to a really very successful business. Along that way, the person they had there at the beginning is probably somebody good for them. And hopefully that person comes and visits. And I know many CPAs, when the client gets to a certain point, they go, okay, you need somebody new. It's hard to do, But a lot of them, and that's the perfect CPA who says, okay, you need somebody better than me. And
ones that are dangerous are the ones that know that and then deny it.
Yeah, and I think, but a good like I say, and like you say, see, a good CPA is worth their weight in gold, I think.
I remember one of my first CPAs. He's long since passed away. Jim Hodges in Charlotte, North Carolina. He calls me one day. I was, I don't know, 2 or 3 years into one of my first businesses, and he called me up and he said, "What are you doing for lunch?" I said, "Why do you ask?" He said, "Because you're coming to meet me and I'm buying because you can't afford it." And he proceeded to dress me down for that hour and a half of lunch, and it had a major impact on the future of my business.
That person is a proactive CPA, which is not their nature. That's generally not their nature. I work with so many over the years. That's not what they do. But a proactive CPA is tremendous.
Yes, and you want somebody who's going to be a surrogate CFO for you.
Yeah, essentially, that's exactly what you want.
Yeah, exactly. All right. Well, you can't get away unscathed. I have to ask the bonus question. Joel, what personality trait has gotten you into the most trouble through the years?
You mean in my practice or just generally?
Either or, take your pick.
I think that the one that's got me in trouble in my practice, and I've gotten away from this now, luckily, I guess I learned my lesson, was sometimes I would push too hard on the IRS to the point where I had a good settlement and I kept trying to make it better. And there really was no better to get, and it's caused problems, and the clients got mad at me, but I fixed that problem. But sometimes you just see the snowball rolling down the hill, and you're thinking, hey, we can jump on and get some more. We can jump on and get some more. So sometimes there is no more to get. And sometimes that got me in trouble a few times early in my career.
In sales, you know what we call that?
No.
Buying it back. It's once you've made the sale, don't buy it back.
I like that. I like to use that.
So how can our viewers and listeners get in touch with you?
Well, they can always get in touch with me by email, jcrouch@meadowscollier.com. You can also call me. I'll give you my direct dial number. It's 214-749-2456. Happy to answer any kind of questions I can. And I really enjoyed being here today, by the way. This is great.
Hey, thanks for being our guest and sharing your wisdom and knowledge. I feel like we really only touched a tip of the iceberg here. You're going to have to come back again soon. Thanks for being with us.
This is fun. This is really fun.
Awesome. You can find Joel Crouch at meadowscollier.com or on LinkedIn. And of course, you can always reach out to me and I'll be happy to make a warm introduction to my good friend. This is the Maximize Business Value podcast, where we give practical advice to business owners on how to build long-term sustainable value in your business. Be sure to tune in each week and follow us wherever you found this podcast, and give us a comment or a suggestion for a future podcast. And we'd love for you to subscribe to our Maximize Business Value podcast channel on YouTube, where you'll not only find every episode of our podcast, but you'll also find hundreds of other videos and free content to help you maximize your business value. So until next time, I'm Tom Bronson, reminding you to think about the tax consequences while you maximize business value.
Thank you for tuning in to the Maximize Business Value podcast with Tom Bronson. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition on their terms. Learn more on how to build long-term sustainable business value and get free value-building tools by visiting our website, www.masterypartners.com. That's master with a Y, masterypartners.com. Check it out.
That was perfect. I wouldn't make any changes on that.